You can make six figures and still be one bad month away from disaster, while your neighbor pulling in half that is quietly sitting on a paid-off house in a fat retirement account. That is not a fluke. It is not luck, and it is not some secret investment nobody told you about. It comes down to 10 small, almost invisible habits, and most people are doing the exact opposite of what actually builds wealth without even realizing it. By the end of this, you will be able to spot these patterns in your own life in about 30 seconds flat, and honestly, some of them might sting a little. Let's get into it. Number one, they check their bank balance instead of avoiding it. There is a strange kind of denial that creeps in when money feels tight. People stop opening the app. They stop looking at the statement. They let the number become a mystery because the mystery feels safer than the truth. But the people who end up financially secure do the opposite. They look at the number often, even when it is ugly, because you cannot fix what you refuse to see. Avoidance does not make a problem smaller. It just makes the eventual reckoning bigger and a lot more painful. Number two, they let lifestyle catch up to income every single time a raise arrives. This is one of the sneakiest traps out there, and it has a name: lifestyle creep. The paycheck goes up 10%, and somehow the car gets nicer, the apartment gets bigger, the takeout orders get more frequent, and at the end of the year, the amount left over is exactly the same as before, or worse. The raise never actually reaches savings because it gets absorbed before it even has a chance. People who build real security treat a raise as an opportunity to increase what gets saved first, and only then decide what, if anything, gets upgraded in daily life. Number three, they carry a balance and just accept it as normal. There is a huge difference between using a credit card and being used by one. When a balance rolls over month after month, the interest quietly eats away at money that could otherwise be growing. Plenty of people treat a minimum payment as proof that everything is under control, when in reality it is proof that the debt is winning. A $5,000 balance sitting at a high interest rate for years can end up costing more in interest than the original purchase was ever worth. That is money handed to a bank for nothing in return. Number four, they buy convenience instead of building a little friction into spending. Subscriptions that auto-renew without a second thought. One-click purchases at midnight. Food delivery 3 or 4 times a week because cooking feels like too much effort after a long day. None of these choices look dangerous in isolation, but stacked together, they quietly drain hundreds of dollars a month. And most people could not tell you where it went if you asked them directly. The habit that protects people financially is not extreme restriction. It is simply adding a small pause before spending, a moment where the brain gets a chance to ask whether this purchase actually matters. Number five, they treat someday as a plan instead of picking an actual date. Someday I'll start investing. Someday I'll build an emergency fund. Someday I'll figure out retirement. Someday is not a plan. It is a way of postponing a decision indefinitely while pretending progress is being made. The people who actually get ahead pick a specific number and a specific date, set up the transfer, and let it run automatically, because willpower fades, but automation does not. Number six, they compare their spending to their friends instead of to their own goals. Social pressure is one of the most expensive forces in personal finance. The vacation gets booked because everyone else is going. The bigger house gets bought because it is what people at that income level are supposed to have. None of these decisions get made by comparing the cost to a personal financial goal. They get made by comparing a bank account to somebody else's highlight reel. And that is an impossible contest to win because nobody actually knows what is happening behind someone else's closed doors. Number seven, they insure against small risks and ignore the big ones. It is common to see people obsess over extended warranties on a $200 appliance while going without proper health coverage or life insurance if they have dependents. The small, unlikely losses get all the attention because they feel tangible, while the catastrophic, life-altering risks get pushed aside because they feel distant and unpleasant to think about. Real financial protection means covering the events that could wipe out years of progress in a single afternoon, not the ones that would only cost a minor inconvenience. Number eight, they let fear or excitement drive investment decisions instead of a plan. When markets drop, panic selling locks in losses that would have recovered given enough time. When some new trend takes off, the fear of missing out pulls money into things nobody fully understands. right before the excitement fades and the price comes back down to earth. Consistency beats emotion in the long run, almost every single time. And the people who avoid these swings usually have a simple, boring plan written down somewhere that they just keep following no matter what the headlines are shouting that week. Number 9, they never separate needs from wants, honestly. Ask most people what counts as a necessity, and the list quietly balloons to include things that would have sounded like luxuries a generation ago. Streaming packages, the newest phone every year, dining out multiple times a week. None of these are inherently wrong, but calling them needs instead of wants means they never get questioned, and anything that never gets questioned never gets trimmed when money gets tight. People who build a cushion tend to be brutally honest with themselves about which expenses are truly essential and which ones are simply habits dressed up as necessities. Number 10, they measure success by what they can show, not by what they actually own free and clear. This is the habit that ties every other one together. A finance car, a maxed out card used to fund a vacation, a house stretched to the very edge of what a mortgage will allow, all of it can look identical to real wealth from the outside. But there is a massive difference between what a person appears to have and what they would still have left if every debt got paid off tomorrow. The people who quietly build security are not thinking about how a purchase looks to somebody else. They are thinking about whether it moves their own numbers, the ones nobody else ever sees, in the right direction. None of these 10 habits are dramatic on their own. Nobody goes broke because of one bad decision, and nobody becomes financially secure because of one brilliant move either. It happens slowly, through hundreds of small choices repeated over years, until one path leads to freedom and the other leads to a lifetime of feeling like the money just disappears, no matter how much comes in. The good news buried in all of this is that every single one of these habits can be changed starting today, and it does not take a bigger paycheck to do it. It just takes noticing which of these you are already doing without thinking and deciding on purpose to do the opposite. So take an honest look at that list. Which of these habits sounded a little too familiar? And which ones did you already catch yourself doing right without even realizing it was a good sign? The gap between those two answers is probably the most useful financial insight you will get all week.